Okay, ladies and gentlemen, welcome to the current installment of our IMFS webinar series. We're delighted to have Gaston Gelos with us. He's coming directly to us from the BIS, zooming in from Basel. He is deputy head of the Monetary Economic Affairs or the Economics Department at the BIS. He has a long career. He actually has a PhD from Yale in economics, had a long career at the IMF, at the end as assistant director there, covering different positions as economist, but he actually worked intensively on issues of financial stability, also at the IMF. And I recall both with you and with your successor or colleague from the IMF, we also had various presentations of research from the IMF with a broader policy relevance already, such as macroprudential or capital regulation policies. But now he's at the BIS, and he will tell us about the BIS Annual Report, which already has raised quite some headlines in the news. And so we're really keen to hear your presentation, and there will be ample time for Q&A. As usual, we'll have the Q&A in the following way. Please, for the participants, please add your questions. You can already start during the talk adding questions in the Q&A tool. So here depending on whether you have a German or English version, there should be a Q&A or F&A tool on your task line there of the Zoom program, so you can, and I'll be able to see them. I'll be reading the questions, and then Gaston can answer them. So I'm looking forward to that. And Gaston, without any further delay, let's go in your presentation, see what you can tell us about what we should worry about in terms of the financial situation and stability of the international financial system, or whether we should be totally relaxed. I mean, maybe one more thing before I let you start. But I was just at the Sintra conference, and your former IMF colleague was there, Tobias Adrian, talking about also financial stability and AI. Maybe this will be a topic here also. Generally, my impression at Sintra was that, yes, things could happen, but it's not, but still relatively a secure impression was actually generally given. So I'm keen to hear what you have to tell us about that. Thank you.
Thank you very much, Volker. Thank you for having me in this seminar. Let me share my presentation. Yeah, so the Annual Economic Report is the BIS flagship publication, in which we set out our perspectives on key developments and challenges facing policymakers around the world. And we have 3 chapters. The first chapter reviews the past year and highlights key pressure points for the global economy. The second chapter delves more deeply into the challenges central banks face, from historically high public debt and changes in financial markets. And chapter 3 discusses digital innovation in finance, the potential for tokenization, and the limits of stablecoins, and how to maintain trust in money in the digital age. So if we look back over the last 12 months, they have been eventful. And a year ago, a bit over a year ago, there were fears that higher tariffs would slow global growth and trade significantly, particularly in the US and among its closest trading partners. As you see in the charts, growth expectations were sharply revised down for many economies, but later improved. And fortunately, as we know now, the global economy proved resilient, and for 3 main reasons. First, the effective tariffs were lower than initially feared. The peak announced US tariff rate was about 25%. But due to trade deals and exemptions, the effective rate ended up closer to 10% on average, as you can see by comparing the blue and red lines in the graph on the left. These lower than expected tariffs account for about a third of the upward revisions to 2025 growth, shown by the red bars on the right-hand side. Second factor was that firms adapted. So they adapted quite quickly. They front-loaded shipments, rerouted trade, and absorbed part of the cost increases. This helped cushion the impact of tariffs on growth and inflation, at least temporarily. Third, a surge in optimism about AI spurred a capital expenditure boom on AI-related infrastructure. The effects were felt most strongly in the US, but also had a global spillover along the AI supply chain. And then the same optimism also supported risk appetite and kept global financial conditions loose, despite high policy uncertainty and geopolitical tensions. And this is an important tailwind that is very much still at work today. So together, these three factors contributed to strong upward growth revisions in the second half of last year. And by the end of last year, global growth was close to what had been expected before the tariffs had been announced. So the global economy entered this year with a good momentum, which continued until the outbreak of conflict in the Middle East. And that conflict marked a new negative supply shock. And it was a major shock. The reduction in oil supply following the closure of the Strait of Hormuz was unprecedented. In volumes terms, it was larger than the 1970s shocks, as shown on the graph on the right. As a result, growth projections were again downgraded in many economies. Nonetheless, financial markets kept buoyant. Equity prices rose and oil prices futures did not rise too sharply, partly because of an expectation that the conflict would be resolved fairly quickly. And recently there were signs that the Strait of Hormuz might reopen, and those brought further relief to financial markets. Of course, things are changing by the day. So clearly the situation is fluid, and even if the Strait of Hormuz reopens on a more sustainable basis, the conflict effects could linger. So the prolonged production pause across the region could complicate and delay the ramp up of output. There are damaged facilities which need to be repaired, and normalizing shipping will also take time. So looking ahead, the global outlook will be shaped by how the persistent ramifications of AI optimism, on the one hand, and the conflict in the Middle East interact with existing vulnerabilities. And here we highlight 4 pressure points. 1, the return of inflation. Second, risk from AI-related exuberance. Third, amplification from existing financial vulnerabilities. And fourth, pressures on public finance. So first, inflation. So as shown in the chart on the left, global inflation has already risen by 1 percentage point since the conflict began. And even if the strait is sustainably reopened, the risk is that this initial increase persists. Given time lags in production, rises in the prices of output, in key inputs like plastics and fertilizers, these could continue to exert upward pressure on inflation, even if energy flows and oil prices normalize. So even if these pipeline pressures themselves may be temporary, high inflation could become entrenched. And why? Well, because of memories of the previous inflation surge are still fresh in people's memory. And households and firms' expectations, inflation expectations, could de-anchor more quickly than in the past. But fortunately, there are also mitigating factors. For example, economies have more labor market slack than in 2021, which should contain wage pressures, and monetary policy is arguably somewhat tighter than during the last before the last inflation surge. The second pressure point relates to AI. Over the long term, it promises to lift productivity and serve as a powerful engine for growth. But it remains to be seen how this will play out. At the micro level, studies consistently show that AI delivers large efficiency gains. At the aggregate level, however, the effects seem fairly modest so far, probably reflecting challenges in adopting the technology at scale and integrating it with production processes. But still, it's likely that productivity gains at the aggregate level will also materialize eventually. But AI development also raises fundamental questions about the future of work and income distribution. To date, at least, big labor displacements still have to occur, but there are signs of possible adjustments to come. Already, US industries with higher exposure to AI show lower employment growth than the less exposed counterparts. AI also has monetary policy implications potentially, and what it, for example, implies for the path of R star depends on various factors, and which we discuss in more detail in the chapter. But AI exuberance also has implications for the near-term outlook. Today, as I mentioned, it has provided an impetus to growth, and the question is whether it can be sustained. One risk is that large-scale investment in AI infrastructure becomes excessive because each firm tries to outcompete rivals and dominate the market share. This could create vulnerabilities if AI underdelivers. It could bring the investment boom to an abrupt halt with significant macroeconomic consequences. And this is, we have seen in history that boom-bust investment cycles often accompany technological breakthroughs, as you can see here on this chart, where we see parallels to the canal mania, railway mania, the Roaring '20s, dot-com boom and bust, and so forth. Now, the third pressure point comes from financial vulnerabilities. Easy financial conditions are partly driven by a compression of risk premia, as shown on the left-hand side. Stretched equity valuation could unwind abruptly and amplify adverse scenarios in which, say, the interest rates have to rise because of inflationary pressures, or AI payoffs disappoint. This time around, a large correction in AI-driven valuations could carry more pronounced wealth effects and sharper drops in consumption, since household exposures to equity markets have grown, particularly in the US, as shown in the graph on the right-hand side. AI firms have also relied increasingly on debt to finance their activities, as shown here on the left. Should the current aggressive pace of AI capital expenditure deployment slow or come to a halt, borrowers may struggle to service their debt. In addition to leverage, the opaque and circular financing structures of some AI activities, as well as the growing footprint of private credit, further highlight the potential for financial amplification. So it is that in such an environment, if you have a sudden repricing of credit risk, either triggered by AI disappointment or higher interest rates or another factor, that could tighten financial conditions significantly. So that's the current tension between exuberant risk appetite on the one hand and persistent macro risk, and that tension could resolve in a disruptive way, potentially. The last two pressure points, which I will mention, are not new. They are fiscal fragilities and financial fragilities, but the risks they pose have grown further and are changing in nature. And this is something that we analyze in the next chapter, which I will cover in turn. And here, we all know about the rise in public debt in major economies, many economies around the world, both in advanced and emerging market economies. A lot of that can be attributed to the fiscal response to a series of major shocks, such as the global financial crisis, the COVID pandemic, and the energy crisis following Russia's invasion of Ukraine. But it also reflects a broader challenge. Many countries do not consolidate sufficiently in economic upswings. Moreover, the markets that absorb that larger volume of debt look very different from a decade ago, and that has created new vulnerabilities. Let me turn to the policy challenges of the pressure points I have mentioned so far before delving a bit deeper into the fiscal financial fragilities I was just alluding to. So, from what I have discussed briefly so far, for monetary policy, the priority is to preserve price stability in the face of adverse supply shocks, AI-related uncertainty, and deteriorating fiscal positions. And for fiscal and structural policy, it means, well, improving the fiscal trajectories by reconciling growing spending needs with fiscal discipline, foster economic resiliency, and transform AI promises into durable gains. And for financial fragilities, and I will discuss this in more detail, broaden the oversight and regulation before the traditional banking perimeter. Now, let me get a bit deeper into what I was just touching upon, namely the challenge posed by high public debt and the shifting nature of financial markets. So, as I was mentioning, public debt in many economies has climbed to high levels. In fact, to levels close to peaks reached after World War II. And those levels are set to remain high because fiscal deficits are still large and structural spending pressures from aging and investment needs continue to build, not diminish. At the same time, the structure of sovereign bond markets has shifted in important ways. We have now leveraged non-bank financial institutions, particularly hedge funds, playing a large role in intermediation. And these hedge funds rely heavily on short-term funding and are very connected to both banks and other NBFIs. So these developments have created a new fiscal financial stability nexus in which stress can propagate quickly through funding markets, across borders, and between banks and non-banks. As a result, government bond markets, the liquidity therein can appear ample for long stretches, but evaporate quickly when shocks hit, raising borrowing costs and compressing fiscal space well before fundamentals alone would suggest. So we believe that against this backdrop, central banks face three interrelated challenges. First, when investors reassess fiscal sustainability or liquidity, sovereign yields can move more rapidly and more often, tightening fiscal conditions quickly while having less certain effects on inflation. Second, high public debt makes monetary transmission more complex by altering the balance among valuation effects, interest income transfers to bondholders, and potential repricing of risk. And third, market dysfunction episodes may require more frequent interventions, but repeated interventions risk encouraging maximizing leverage, worsening the problem, weakening market discipline, on fiscal policy and blurring the monetary policy space. Now, these charts, you have seen similar charts. They show that government debt to GDP ratios are projected to remain elevated over the coming years. They may come down a little bit in the next few years, but overall they're gonna remain high. And there are some factors that I was already mentioning that keep exerting pressure on the fiscal. Fiscal pressures stem from demographics, pension, health expenditures, demands for public investment in infrastructure, defense, energy transition. And at the same time, of course, the financial environment is less benign. Interest rates are higher than in the past. Growth has slowed. And so the debt dynamics have become more complicated. So as I was mentioning briefly already, why are we where we are? Well, partly it's because fiscal policy in many countries has been asymmetric. Governments have tended to ease aggressively in downturns, but have not rebuilt sufficient buffers when times were good. And that tendency seems to have worsened since around 2000, with governments appearing to have become less responsive to rising public debt levels. So this chart documents how fiscal policy has allowed debt to drift over time. It's based on econometric analysis, and what it shows really is that while primary balances tended to improve as debt rose in the 80s and 90s, so in response to higher debt, fiscal balances improve because fiscal policy was adjusted, that responsiveness has largely vanished in recent decades. So in other words, the primary balance no longer strengthens as much when debt climbs, even controlling for the business cycle. And you can look at it in a slightly different way by how counter-cyclical, pro-cyclical fiscal policy has been. And here it has also been asymmetric. Fiscal tightening in good times has been much less forceful than easing in bad times, particularly, that's interesting, in advanced economies. So instead of rebuilding buffers in good times, fiscal policy has tended to deteriorate the situation. So compounding the challenges by higher debt, the markets now that are different. The markets that absorb this larger volume of debt now look very different from 2 decades ago. Intermediation has increasingly moved beyond banks to non-banks. At the same time, official sector holdings have declined since central banks have reduced their balance sheets and foreign official purchases have moderated. And so the increased supply has to be absorbed by the private sector. So in most countries, pension funds and insurers continue to provide steady long-term demand for government debt. That's good, but there are also highly leveraged hedge funds now that play a much bigger role in intermediating government bonds. You can see in these graphs how their importance has risen over time. So measured relative to GDP, for example, in the US, sovereign debt exposures of hedge funds there have doubled, more than doubled since 2022, as leveraged so-called relative value strategies of these hedge funds expanded rapidly. But that's not purely a US phenomenon. You have seen this, we have seen this in other advanced economies. In the euro area, hedge funds' share of electronic trading in government bonds has risen considerably, and we have observed similar patterns as well as in Canada and the UK, for example. And here, the funding terms that these hedge funds face, they have been very lax. with a large share of bilateral repos extended at zero haircuts, especially for the largest funds. What does it mean? Well, this means that such terms allow very high leverage, but leave positions acutely sensitive to shifts in margins, haircuts, or derivatives pricing. And here the charts capture the combination of changing holders, rising hedge funds exposures, and the broader trading footprint. And this underscores why liquidity can dry up quickly when risk capacity tightens, and why market functioning has become more vulnerable to shocks. So these two charts here now, they show that although banks' direct sovereign exposures have or the link between the co-movement between bank and sovereign risk now appears less sensitive to banks' direct sovereign bond holdings than a decade ago. By contrast, the nexus has broadened through indirect channels. So banks' links to NBFIs, including hedge funds, via repo financing, prime brokerage, derivatives intermediation, and funding from money market and other funds have become more important in transmitting shocks. So on the one hand, the traditional bank sovereign nexus has weakened somewhat. It remains important. But on the other hand, the co-movement of bank sovereign CDS, the nexus between banks and CDS has become more sensitive to the degree to which banks are exposed to non-bank financial intermediaries. So the nexus has become a bit more complex. Now, what does it mean? All this rise in debt, the changes in financial markets. Well, risk to financial sustainability, they can have important market effects and real effects. So when markets reprice fiscal risk, sovereign yields typically rise and currencies tend to depreciate, typically tightening financial conditions. Because government yields are the benchmarks for many private borrowing costs, this repricing raises funding costs for households and firms. It can also trigger capital outflows. So the charts on this slide trace these dynamics. Higher government bond yields on the left-hand side, and a weaker nominal effective exchange rate on impact. The effects on inflation and activity change over time. In the near term, weaker currencies and high expected inflation compensation can lift consumer price inflation as imported prices rise and expectations adjust. Over the medium term, however, tighter financial conditions weigh on aggregate demand, and disinflationary forces dominate as real activity slows. So a critical dimension of the new fiscal financial stability nexus is the interactions between fiscal risks, sovereign bond market functioning, and intermediaries' balance sheet health. These are complex, as I was already showing with some graphs earlier. Take, for example, a negative shock that leads markets to reassess the fiscal sustainability of a jurisdiction. In illiquid conditions, when intermediaries' balance sheet capacity is strained, the impact on yields will be higher than otherwise. At the same time, the initial shock will also tighten margins and compress intermediaries' risk-bearing capacity, prompting deleveraging, which will further adversely impact market functioning. And empirical estimates confirm this interaction. The absolute magnitude of fiscal surprises is larger. The effect is larger in liquid markets on the left graph, and adverse fiscal surprises in turn, they erode market liquidity. So the impact on sovereign yields are stronger when markets are illiquid, but adverse fiscal surprises have a bigger impact when markets are illiquid. Now, how does it affect monetary policy? Well, high debt also changes how monetary policy transmits to the economy. And here there are various channels that matter. First, rate hikes can worsen the fiscal outlook by raising interest costs, prompting markets to widen risk premia, and amplifying the tightening in the financial conditions. Second, valuation effects from higher yields impose mark-to-market losses on holders of longer duration debt, curbing their risk-bearing capacity and credit supply. Third, higher rates increase government interest payments, transferring income to bondholders. So you have a bunch of different effects going partly in different directions that complicate or at least change monetary policy. Overall, I would say complicate. Now, how exactly that plays out also depends on the maturity of that, and I don't have time to go into those aspects. So, based on this analysis and this discussion, the policy message from all the evidence we have in the chapter is that credible monetary, fiscal, and regulatory frameworks must work together to manage the new fiscal financial nexus. Monetary policy will need to navigate a narrower path. So if in this environment there's too little tightening or not tightening, this could lead to a de-anchoring of inflation expectations, while too much tightening could lead to outsized market reactions given the fragilities that I've discussed, the leveraged intermediation on core markets. Overall, of course, central bank independence is essential, but it is most effective when supported by credible fiscal sustainability and a resilient financial system. So on the fiscal side, the priority is to place public finances on a credible and sustainable path by restoring symmetry to fiscal policy. And that means rebuilding buffers during expansions within well-specified medium-term frameworks, enforced rules, and effective fiscal councils. And here, the composition of consolidation matters. You don't want to cut indiscriminately. You want to cut public investment only there where it's superfluous. You don't want to cut public investment that can undermine in a way that can undermine potential growth. You want to protect growth enhancing investment and pair it with structural reforms that expands the tax base and reduces debt ratios over time. Regarding the financial fragilities, the changes in financial markets, well, here we have a big challenge because of the complex interplay between banks and non-banks. It's not only about the banks on the one hand and other players on the other hand. They are linked, and so we need congruent regulation. That is, regulation that tackles similar risks with similar stringency across banks and BFIs. Here, priority areas include leverage limits, liquidity mismatch mitigation, and a stronger oversight of fragile funding structures, so that we don't get into this situation that the fragility worsens and worsens. But we should also maintain prudent banking regulation, because this problem cannot be improved. In fact, it would get worse if we loosened bank regulation, because they provide the funding, or a lot of the funding, to the hedge funds and other NBFIs. Central bank liquidity backstops are important. They remain a powerful tool to address market dysfunctions, but they must be very carefully calibrated. Um, they should be temporary, targeted, and easily reversible. For example, as the Bank of England responded in the 22 liquidity-driven investment crisis. Expanding counterparty access to NBFIs could enhance the ability to address dysfunction through lending rather than asset purchases, but requires robust regulation to mitigate risks. So the bottom line is that acting across these domains reduces the likelihood that future shocks will force difficult choices between price stability, financial stability, and fiscal sustainability. Now, I don't think we have time to really go through the third chapter, but let me just tell you very broadly what it is about. It is about financial innovation, innovation in the financial system, and how to think about it and how to preserve the good aspects that have emerged in the financial system over time, which is really based on trust. So money is based on trust, and today's two-tier system delivers that trust by combining central bank money, the first tier, as the anchor, with private sector money, the second tier, at the user interface. And so this has emerged over centuries of experimentations and sometimes crises, and works well. But we want to also make use of the new technologies, tokenization, for example. And so we discuss how to do that. And we also discuss where stable coins fit in this picture and the limits they have and the potential impact they may have if they were to be adopted more widely. And also we discuss some progress toward really adopting modern technologies to overcome some of the existing frictions in our current system. But let me stop here. Perhaps we can resume with on those themes as well in the discussion. Thank you.
Excellent. Thank you, Gaston. That's great. Fascinating report. Well worth reading, I think. Well deserving of the attention it's been getting. And as I see, maybe one quick remark to our participants, listeners, you can now, if you open up the F&A or Q&A tool, you can enter questions. Just write in a question. I'll read it, and then Gaston can answer them. I think there are a lot of issues we could discuss. We could also go deeper into the digitalization of the financial sector. So please feel free to write in some questions. In the meantime, I will start the Q&A. But I'm looking forward. We have lots of very competent participants here in the online, and so I would be keen to hear what are your concerns or expectations at the moment, and we can have this unique opportunity to get a bit of a response from BIS official, I mean, Deputy Head of Multi and Economic Affairs with Gaston. So Gaston, from my side, first, I thought it was very interesting, this broadening of the sovereign bank nexus. I didn't see that so neatly presented, also quantitatively, as you just did that before, involving the non-bank financial actors. So let me ask one question in that regard, the effects of fiscal policy, which I think you didn't mention so much. I mean, thinking of the last rise of inflation, from a government perspective, it had a lot of beneficial effects because it reduced debt to GDP ratios. And given where debt GDP ratios are going with current policies or where they are in some large countries, doesn't it look very tempting to have another, medium-sized inflation round, not too long lasting, maybe with a late monetary policy response again to get these debt to GDP ratios in line. I mean, so fiscal sources of inflation. You mentioned a lot of fiscal risks, but how do you see that as a driver of inflation? And then you mentioned also very interestingly the AI effects, and I was thinking maybe you could share a little bit more on the thinking as you guys were preparing the report. How do you assess the overall impact, this discussion about the impact of AI, which ranges from extremely optimistic scenarios, right, where we can all retire, to scenarios which are, lead to our extinction threats of humanity. And so, do you see AI more as well? It's another round of technological innovation and the typical risks that maybe if investment gets ahead of itself, there will be a correction. And as long as it's equity based, it's fine, and we have to worry a bit about the banking. Or is this different from other technological booms?
Thank you very much, Volker. Well, on your first point, we do discuss, for example, how that could hamper monetary policy, and one channel through which it could affect monetary policy is indeed the notion that firms and households may start to believe that monetary policy may not act as decisively as needed, and thereby, lead to an anchoring, or at least to an increase in inflation expectations, which of course per se complicates the job of monetary policy further. And that's certainly one aspect that's important in the big picture. As a footnote or a side comment, we have looked at, and with some co-authors, we have looked at how changes in unexpected changes in debt affect longer term expectations, and trying to control for demand effects associated with fiscal expansion. So we try to not to get at those demand side effects, but really at what the debt increases mean for the perceptions of the longer term inflation projection. And we see so far, at least, that there is some of that in emerging market economies. So far, not for advanced economies, but it's not a theoretical possibility. It exists. It exists, and in some economies, and the more that growth, the more that could become a real threat, even in advanced economies. Now, on AI, yes, we have a discussion also based on some modeling in the report, and the issue is quite complex, right? Because it has the potential to differ fundamentally from earlier waves of technological process, because in the past, when we had the invention of the steam engine, electrification, or things like that, those raised workers' productivity, providing them with better tools, generated more income, new forms of employment, and everybody was better off, at least after some adjustment. But here, the macroeconomic consequences could be very different, because the constraint that you usually have on long-term growth, namely the ability to generate new ideas, could be lifted. And but it really depends. That you could imagine a situation where the gains go to capital, and there is not enough demand really to sustain the investment that's needed to keep that AI-driven investment going, so that it kind of collapses in itself. Right, so it raises different possibilities, and it's at this point quite unclear where we're going.
Okay, thank you. I have two questions from the audience. Maybe the first one, let me read that. That fits right in what you were just talking. So Luca Schmidt asks, how do you think AI will impact the inequality between advanced economies and emerging markets, right? So will advanced economies and emerging markets be affected differently, and will it really do create structural changes there?
Well, here it's also, I think, one cannot be too simplistic, right? I mean, on the one hand, um, countries clearly differ markedly in their AI readiness. And my colleagues have looked at, and they assembled like an indicator of how ready are different economies to the adoption of AI.
Hmm.
Um, and and there is a big variation, but that variation is not uniform in the sense that it's not advanced economies on the one hand and emerging market economies
Hmm.
or developing economies on the other hand. It's conceivable that, for example, there could be huge productivity gains even for very poor countries that have access to tools and that were previously completely, off limits to them, right? But at the same time, they don't have the infrastructure and often limited in their ability to access them. So I suggest you also take a look at some work that my colleague, in particular Leonardo Gambacorta, did on this issue.
Thank you. Actually, if I may, that sounds very interesting. You talk about this index. I mean, I don't know, you may not know off the top of the head, but it triggers me a bit to find out where Germany stands within advanced economies or within European economies in terms of AI readiness, just in case you have that. But we can also move on. I can look at the source you mentioned later.
Yeah, I don't have it on the top of my head,
Yeah.
but I can
But
share.
anyway, because I'm also working a little bit on advising some 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 parts of the German government, and so we're trying to get more ready and get it implemented in industry, also medium enterprises. But let me go to the next question. Sodik Umarsako, which links back to the public debt, and he asks. Given your result that high public debt can blunt the price effects of monetary policy, do you think central banks now need to react differently in high debt countries, or should the main adjustment come from fiscal consolidation? Of course, we have some central banks, such as the ECB, which deals with both high debt and medium or moderate debt countries. But we have many other countries. I mean, you interestingly look at, right, advanced versus emerging economies. So it would be very interesting to understand that better. Main focus on fiscal adjustment, fiscal consolidation, or do we need different responses in central bank, particularly in high debt countries?
Well, I mean, on monetary policy, there, as I didn't have much time, but briefly alluded to the different effects of high debt on the transmission of monetary policy, and they vary partly with the maturity structure of the debt, um, and but also with other aspects of the economy, namely, for example, how quick is an effect on exchange rate. So overall, I would say their monetary policy would have to calibrate to those changing circumstances, but should continue to focus on its job and should focus primarily on price stability. And but we say that we need all policies to work together, right? We need fiscal consolidation. We need fiscal policy restoring the fiscal trajectories to a sustainable path in a credible manner and in a way that doesn't hurt growth too much. And we need monetary policy, retaining its credibility. Um, and we need proper regulatory responses to the changing and partly emerging fragilities on financial markets.
Thank you. I mean, if there's no, I mean, to the audience, if you want to add another question, just write in the Q&A tool. So feel free to do that. But if there is no more question, let me add one topic. In your presentation, you couldn't really go much into chapter three. Now, also from the background of last week's ECB Sintra conference, maybe a question for me on that. At the Sintra conference, Hyun Shin, who you worked with in the past at the BIS, he presented both work at the Bank of Korea on tokenization and having a digital platform which links central bank money and the private sector and programmable money, right? To make it to actually link that direct, create in a sense, if I understood it correctly, programmable central bank money. And at the same time, he alluded to or talked a bit more briefly about the work at the BIS, right, which has generally helped or push along with the project, which creates a platform for countries or for central banks to at least link the central bank money to via a platform to digital money and smart money and and crypto of the private sector and the tokenization, say, of deposits, which banks may want to offer, right? And on the other side, and so basically European countries seem to be into that to some extent. And, Hyun was presenting the work at the Bank of Korea and mentioned others and the work at the BIS. But I got a different impression from the US, right? So the US, although they were more or less part of this project, there was a stronger emphasis on stablecoins and certainly not on creating programmable central bank money. At least that's how I took it from some of the people, from the US side. So is there another element of this is that at least in Europe, right, there's a strong emphasis on pushing forward with central bank digital money, which, when you think about tokenization of deposits, it's not clear what the CBDC does for the households on top of that. But anyway, so there is an affinity to that, and that has been, at least in the US and maybe also in England, has been nixed, has been stopped, right? They don't want to go for central bank digital money for households and firms. So there is a clear difference between US and other players. What about these platforms and the tokenization of money and the role in tokenization of deposits, and the central bank's involvement in that, right? So I created a bit of a broad brush thing, but I hope it's clear.
Yeah.
There seems to be a very different agenda, to me at least, from the US and some of the other players. And since the BIS is kind of servicing a service organization for all these central banks, this must be something which comes up.
Well, it's certainly true that different countries, different jurisdictions are approaching this in slightly different manners, and some are just have been emphasizing modernizing their payment systems and just moving first to fast payment systems and making great gains with that. What we've really tried to do in this work and other work is to lay out conceptually some of the key issues. For example, we say, okay, stablecoins depends on what you envision them, what you want them to be. That has consequences for their regulation. So if you want them to be like investment assets, securities, like money market type fund instruments, that's one thing. That means that their value can fluctuate a little bit. It's not a big deal. If you want them to play the role of money in the system or important role as money in the system, then you're in a different ballgame. Then, they need to be redeemable at par at all times, particularly at times of stress, right? You need to be sure that your stablecoin is, whatever it is, $1 or €1, but typically it's $1. Most of them are denominated in $1 at all times, and that requires certain types of backing, of assurances, of potentially backstops, and so forth. So that's one thing that we highlight, and we highlight why certain aspects of money are very important and why they're worth preserving. And there is a way. I mean, there are many ways of preserving that. One that we think helps, on the one hand, take advantage of those innovations of having programmable payments where you can execute everything in one go, so to speak. You don't have to go through multiple layers of reconciliation and checks and so forth, and incur risks with counterparties, but have one transaction go through only if every condition is fulfilled, and have the say payments against the delivery happen only then. Well, that you can achieve, for example, without losing this, what we call, or others call this singleness of money. So that means that a dollar is a dollar, no matter what bank you use, and because it's settled at the central bank. And so having using collateralization, tokenization for central bank reserves, for deposits, and starting perhaps with sovereign bonds, that would be like a trilogy of key assets in the financial system. That would be a way of integrating those technological innovations into an existing system. And we have shown that you alluded to it with the project Agora, that
Agora, yeah.
you can do something like this. That is more about cross-border payments, where the problem is really arguably the biggest, right? When you transfer money abroad, the costs are really high typically, and the delays are large. And in that project, we bring together 8 central banks and over 40 regulated institutions, and have been testing a shared cross-border platform with a unifying ledger for tokenized commercial bank deposits, and separate jurisdiction-specific ledgers for tokenized central bank reserves, so that central banks retain control over their currency. And there's a prototype, and it shows that after the validation steps are completed and the required balances are reserved and locked, payments can settle atomically, that is, across currencies, in an all-or-nothing manner. So it seems to work, and it's just it's a prototype, but it is a way how to take advantage of these technologies and improve cross-border payments, for example.
Excellent. And yeah, cross-border payments, there are still, although there have been some improvements, right? There are still some significant transaction costs. Yes, maybe this would actually be a topic in the future as there's more progress on these systems, and maybe how it could also help reduce risks. I don't know. I mean, maybe this is a topic we could think about for a discussion in the future. Anyway, it was great to have you today. Great report. I found it extremely useful. And thank you to everyone for attending, for the questions. We close here. Wish everyone a good summer. We'll be emailing soon about future topics coming after the summer break. So all the best, and thank you, Gaston, for joining us today.
Thank you very much, Volker, and also I wish you all a good summer.